A very good afternoon to you all, friends. I am Sanjeev Singhal, Central Council Member and Chairman, Auditing and Assurance Standard Board and Chairman, Sustainability Reporting Standard Board. I, on my behalf, along with my very esteemed Vice Chairman, CA Vishal Doshi ji from Vadodara, who is not only the Vice Chairman for this AASP, but also for Expert Advisory and Board of Studies, and a member of the Disciplinary Committee of the Institute of Chartered Accountant of India. Both of us welcome you to this 92nd program of the AASP for this council year. And friends, so far, 1,05,226 members have attended these programs. That is the first 91 programs. And we have covered every possible topic within the auditing framework, be it the various auditing standards or the guidance note or Schedule 3 or CARO, or the specialized topics. We have covered each element of financial statement. We have so far also covered the notes to the account, etc. And as you are aware, this year we have run two helplines. One was during the bank audit season for resolving the bank audit queries. That was from April 1 to April 15. And second, probably the largest panel that we have run from April 16 to September 30, in which we have handled the audit-related queries of all of our members, whether audit of corporate sector or non-corporate sector. And we were aware that there were 14 lakh corporates and maybe an equivalent number of non-corporates who were going through this audit. And but still, with the blessings of the God and with the help of all the experts, we have taken that step. And 50 experts were involved with us, and they have resolved every possible query of the member if the query was pertaining to the audit-related matters. Of course, accounting matters were not covered because that is not in the domain of AASP. These two successful helplines have been covered, and members have immensely been benefited. AASP also brought out the guidance note, the revised guidance note on CARO in this year, and there are many other projects which we are undertaking. And in the World Congress of Accountant, which will be held from November 18 to November 21, we would request you to kindly visit the pavilion of the AASP as well, along with the other pavilions. Friends, let me say a few words about my Vice Chairman, Vishal Bhai. It's been such a able support right from day one, and coming from the auditing domain. He's a stalwart of the auditing profession, and has shouldered various responsibilities along with me, and that has given me the impetus to undertake more and more initiatives. And of course, Anil Lal has been the backbone of all these programs, organizing these programs very, very meticulously. And of course, the cornerstone of our programs has been our speakers. Naturally, it is on the strength of the speakers that members are able to learn. And today we have none other than CA Jitendra Agarwal ji, who has been my mentor, and at least last 15 years, I'm in constant touch with him. Jitendra ji, or as we call him, Jitu. Jitu sir is a partner with the AASP, with the auditing and assurance practice of Deloitte. He has post-qualification experience of over 3 decades. And last more than 2 decades, he's a partner with Deloitte. He's a member of the Deloitte India Coordinating Board and leads various initiatives for the firm. He has handled firm's largest clients across various sectors. He's an advisory and quality control partner also on many of the clients. He has in-depth knowledge of the Indian GAAP, IFRS, US GAAP, Indian gas, US gas, etc. And probably there'll be hardly any member who would not know Jitu sir, particularly in the Northern India. He has been a member of the Accounting Standard Board as well as AASP of ICI. He's also been a speaker. I know when we started this IFRS certificate course in 2010, I used to request him in every batch, and he was kind enough to come for every batch. And he's a commerce graduate from my own Shri Ram College of Commerce. So thank you very much, sir. Thank you for taking out time. And before I invite you to deliberate on your technical session, I would invite my very able Vice Chairman, Vishal Bhai, for his opening remarks. Over to you, Vishal Bhai. And today's topic is very, very important, materiality. because this is fundamental to the entire concept of auditing. And who would be a better person than Jitu sir to talk about? Because we know that we can work only on sample basis. Of course, data analytical tool enables us to run those checks over the entire population, but still sampling is to be done. And while doing the sampling, we keep materiality into account. While issuing our audit report, we keep materiality into account. For example, what is the planning materiality, what is the tolerable error, what is the SAD. We keep those in mind, to be based on assets, to be based on revenue, to be based on the profitability. And then, when we encounter certain errors, if they are below SAD, what is the treatment? If they are between TE and SAD, then what is the treatment? And if these are above TE, then how do we deal with them in our audit report? So these final aspects will be dealt by Jitu sir in today's session. And as I said before, I invite him. I would request my vice chairman for his opening remarks. Over to you, Vishal bhai.
Thank you very much, Sanjeev bhai. A very good afternoon to all the participants over here, to my chairman Sanjeev bhai, to the speaker Jitendra ji, to Anil Lal ji. And well, I would say we are back to business after the festival season got over. In fact, we are still, I belong from Gujarat and we are still into holidays. As you all know, Gujarat has a long holiday as far as the Diwali vacations are concerned. But nonetheless, like the chairman mentioned, I am able to contribute whatever because of him being a friend, philosopher, and guide to me. It's never easy to be first time in the council, and that also in such an important position as the vice chair of the AASB. But under the leadership of Sanjeev bhai, I think there is lots to learn in the whole process. So thanks to the chair, and I think it's because of his efforts and his persistence that we have completed 91 webinars so far, with over a participation of almost, I would say, 105,000 members. And this was his vision when we started the year at the AASB, that like we normally say, कि घर घर पहुंचाना है is a normal terminology we use. He has this vision for the auditing standards that we want to make it reach to each and every member, each and every professional in whatever best possible way we can. Everybody should be educated and be made aware about the auditing and assurance standards. And one thing, friends, I would say, and which is very much relevant to the topic that we are going to discuss today about audit materiality, is that there is a general belief that auditing standards are difficult to follow. At AASB, and definitely with stalwarts and friends like Jitendra ji, we want to send this across a message to our members that the auditing standards are a help for the members to bring about audit quality and audit efficiency. If there is a requirement for an audit documentation or for a requirement under any of the auditing standards, when we follow it diligently, I assure you that at the end of the day, when you look back, you will find that because following a particular auditing standard, you will find that you have increased the audit efficiency and the audit quality, and it's not the other way around. It's not a burden to follow the auditing standards. So just like Sanjeev bhai mentioned about audit materiality over there also, that when the materiality, the levels are planned at the beginning of the audit itself, once they are quantified at the beginning of the audit, the whole audit would be following that pattern, following those thresholds with respect to the different materiality levels that have been plotted for that particular client for that particular year. And I can assure you, and I am pretty confident that Jitendra ji would explain that how that would save a lot of time of the auditors when they actually follow the audit materiality standard and the thresholds, and how they would be able to save time, and how that would bring about audit quality as well as audit efficiency. So with that, thanks to all the participants once again for attending this. Thanks to Jitendra ji for accepting our invitation and guiding members on this all important topic of audit materiality. Thank you, and wish you all a happy learning.
Thank you, Vishal bhai. Thanks a lot. And now I would invite our very learned speaker and honorable member, C.A. Jitendra Agarwal ji, to kindly start his deliberation. Over to you, sir.
Thank you, Sanjeev Bhai. Thank you, Vishalji. It is so humbling that, you people who are at the helm of affairs of the institute, give so much of respect and regard. And I feel very honored with that. Let me put it at the outset. It's a pleasure to be with this audience, with our institute, and any help for the institute is absolutely, always at the back of our heads as we talk to people. And this doesn't only happen on seminars, it happens in person. There are so many people who come up all the time for help, and these doors and our hearts are always open for them. It doesn't start here and it doesn't stop here. And I can assure that I mean each and every word of it. It is a very common thing कि सर आप सारे फोन क्यों उठाते हो? मैंने कभी सारे फोन इसलिए उठाते पता नहीं किसको किस समय क्या जरूरत है.
So nice of you, sir. So
It
nice.
is very clear. And less said than for anybody else, Anil is such a wonderful colleague of ours, such a wonderful member of ours, that it is a pleasure to deal with him. और इनको ना करना बड़ा मुश्किल है. तो इतने प्यार से बुलाते हैं, इतने प्यार से बुलाते हैं कि सर एक प्रोग्राम कर दो. एक क्या इस तरीके से 100 भी करा लें तब भी कम ना लगे. तभी So today is, as all of us know, we are in the middle of finalizing our tax audits. And when Anil bhai called, ke sir ye karna hai, maine kaha bilkul karna hai bhai. We will spare time, and any time spent for good is good time spent, is what I would say here. With this, I will, Vishalji touched upon a few issues, and I would just like to elaborate on that before I come to my presentation. You very rightly said, Vishalji, people think it is difficult to follow auditing standards. It is not. It is just a habit formation. Once we start following the auditing standards on auditing, जिसको हम पहले किसी ज़माने में auditing standards कहा करते थे. Once we start following the standards on auditing, it becomes a habit and it becomes a way of life. I met a fellow chartered accountant and he said, the accounting standards tell us to do documentation. If you do documentation, you'll just be doing documentation and you'll be doing no work. Now, that is, again, it is true and false, but documentation has to be done. Auditing is such a profession today that people look up to us. They say, what have you done? Aapne audit theek nahi kara. That is the only time when documentation comes to our rescue and help. And moreover, whatever we do in our day-to-day lives, we forget what we do today, we forget tomorrow. आप डॉक्यूमेंटेशन की बात कह रहे हैं, डॉक्यूमेंट हमारी ऑडिट फाइल तो 10 साल तक है जी हमारे पास. हमको 4 दिन पहले का तो याद नहीं रहता. अगर हम डॉक्यूमेंट नहीं करेंगे तो हमको 10 साल पहले का कैसे याद रहेगा? So that is very important. Clients come to us that, give us certain details, give us certain issues. Tell us what did you do? Why did you come to this decision? We have it on our files where we took the decision. Clients don't have. Fortunately, in our profession, I'm just taking 2 minutes, Sanjeev and Vishal, just to give a backdrop before
Absolutely,
I
sir.
come.
Absolutely. Most welcome, sir. Entire 2 hours are yours.
I am just, putting everything in perspective because everything comes handy to people. Now people come and tell me, I'm just dwelling upon, what Vishal Bhai said, that people come and say कि difficult है, पर करना है. इसके बगैर गुजारा नहीं है. And it is not only that we have to follow the auditing standards. Let me put it like this, that this is just a guide. We have to do our audits from our heart. Planning materiality is a guide. The other topic that I'm touching upon, SA 450, is, misstatements, evaluation of misstatements. That's also a guide. Ultimately, we have to do the audit from our heart. It is understanding the sections. It is use of a lot of common sense. It is our hunch, as we do work in the profession. And one very important thing is that as we do our training, we do this on a daily basis, and that stays with us for life. None of the other professions in this world, I can tell you, have such a rigor of training and practical application of our education as we have in this Institute of Chartered Accountants of India standards. I can tell you that. And I have felt each and every day of my life. And if I have to live my life again, I would live it like a chartered accountant, I can tell you that. And as an auditor. So with this, I'll come to, and the other point Vishalji touched upon was audit quality. Yes, it does have a saving of audit quality. It does improve our audit quality. He also touched upon saving time. I totally agree with you. It saves a lot of time. And audit materiality, planning materiality, as we call it, is a very critical element for saving of time. Now, with that, I'll give you a very, very brief presentation. It's not a very large presentation. I'll talk more and I'll show you less. But I unfortunately don't know how to share my screen. I'll try and see what I can do best and share my screen.
Sir, we'll make you host first of all.
Yes, sir. Sir is host, sir.
होस्ट तो इन्होंने बना रखा है मेरे को. मैं बस ये देख रहा हूँ
अभी दिखाई तो नहीं दे रहा, अभी स्क्रीन में तो नहीं दिखाई दे रहा होस्ट है सर. अच्छा है सर, इसमें शेयर कंटेंट. यस यस, बिल्कुल दिख रही है. आप स्टार्टिंग में जा
दिख रही है क्या?
दिख रही है सर.
Yes, sir.
This is my brief presentation on materiality. Just 1 minute. I'll do this after a while. So on this one, let me host my presentation. Now, this is the materiality in planning and performing an audit. So what is materiality? I will touch upon that. Materiality is in respect of our financial statements. What is a material amount that we have to consider for our planning and performing? Means we arrive at a materiality that, any amount below a certain amount, we will not kind of be concerned with, or will not bother ourselves unless and until there is a specific reason to bother about it. So we use that in the planning of our audit. So this is the starting point of an audit. We come to the materiality. This is applied both in planning and performing, and in evaluating the effect of misstatements, which I will deal separately in my next presentation. So I'll just give a very broad example. Let us take two companies. One company, say, with a revenue of 10,000 crores, another company with a revenue of 500 crores. Do you think if there is an adjustment of 1 crore of rupees, it will be relevant for both the companies? It may not be relevant for the large company, but it may be relevant for the small company. Come to another number, say 10 lakhs adjustment. It may not be relevant for either company. So how much time do we need to spend on an account balance where there could be an error which is very small? That is where materiality plays a role. We determine a certain amount which is material, and then we will come to how we determine that account and how we use that materiality in the performance of our audit. So this is the starting point of an audit. While planning an audit, we determine the audit materiality. And as we determine the audit materiality, that is one number which comes to use throughout our audit of that particular set of financial statements. What is materiality? It is a threshold at which the information becomes important enough to be reported. So there is a threshold that we set out. How we set out the threshold is what we will come to. But this is a threshold that we set out, that if there is anything which is above or below this, we will need to report, either adjust or report in the financial statement. So this is an important number that we have. Why we do that is to, yes, Anil.
Sir, apologies, sir. Make it full screen, sir. Kindly.
Oh, 1 minute. How do I do
yes.
that?
Yes, sir. Kindly.
I'm not a technology person, but I'll try to do
Sir,
my best.
slideshow.
हो गया क्या?
Yes, done, sir. Done, sir. हाँ जी. Thank you. Thank you.
Okay, good. Thank you for telling me that. I am not very familiar with these things, so I use technical help, but today I'm doing it on my own.
Okay. Fine, sir.
So this includes consideration of whether the reported subject matter information is free from material misstatement. Now, the materiality comes into play for us to determine whether this amount that we have set out, whether the financial statements are free from material misstatement. Now, material misstatement is a word that we use every time. What is material is what is materiality. It helps us to determine the nature of work that we do, nature of testing that we do, timing of our evidence gathering, extent of our evidence gathering. So this is, very important for us, that what is the nature of testing that we do, what is the timing, how much do we test, and what is the extent of evidence that we gather. Now, from a user's perspective, for whom we are issuing the financial statements, a misstatement or the aggregate effect of misstatements is material in the context of surrounding circumstances, and it is probable. 1 minute. Okay, fine. a problem that the decision of a user who is relying on the reported subject matter information and who has reasonable knowledge would be changed or influenced. So that is where it impacts the user of the material. For example, what I mean to say here is that from a user's perspective, it is important that he will also be interested in what is a material misstatement. So from his perspective, if it is not material, he would not be bothered. But if it is material and he has reasonable understanding of the activities of the company, it will be important for him to understand that how much is the misstatement, if at all it is reported. Now, there are two levels. One is the materiality for the financial statements of a whole, as a whole, and the other is the performance materiality. Now, on an overall basis, the materiality as a whole is for the entire set of financial statements. Well, establishing the overall audit strategy of how to carry out the audit, we look at the overall materiality. Materiality, which is for a particular class of transactions, account balances or disclosures, because the accounts will be misstated in case any of the account balances are misstated, or even if the account balances are not misstated, but the individual, I would say, the disclosures are misstated. So either of those would result in a, I would say, misstatement. What is performance materiality? This is a slightly lower level as compared to the overall materiality. So amounts set by the auditor at less than OM to reduce to an appropriately low level the probability that the aggregate of uncorrected and detected misstatements exceeds overall materiality. It also refers to the amounts set by the auditor at less than materiality level for particular class of transactions or account balances or disclosures. This will be for certain individual account balances. So this is a slightly lower level of materiality that we set up. So there are two levels of materiality that are set out, and both are relevant in terms of the testing that we do for the financial statements. So the auditor has to determine separate materiality if misstatements are lesser than OM, or reasonably could be expected to influence the economic decision of users taken on the basis of the financial statement. Now, determining the materiality as a whole and performance materiality. This involves professional judgment. It may be a mathematical formula, but it still involves a lot of professional judgment because qualitative and quantitative measures both are taken into account. We may establish certain percentages in determining materiality, but it's not always the same. For different companies, there could be different levels of materiality. Some of the benchmarks that are included is profit before tax, revenue, gross profit, expenses, total equity or net asset value. I'll just take a few examples here, and in what circumstances each of these are relevant, I'll let you know. For a company which has stable operations and it has profit year after year, it has a regular stream of income, the profit levels are the same. There, the amount which is considered is profit of the company. It could be profit before tax, it could be profit after tax. Normally, profit before tax is considered because the operations are stable. In some companies where operations may not be, if operations are stable, but the profits fluctuate a lot, the industry is seasonal, or whichever ways, it could fluctuate for various extraneous reasons, geopolitical disturbances, their revenue is taken as a benchmark. In certain cases where there are no revenues, where expenses are prime, for example, there are certain companies where expenses are significant. For example, there are companies which operate in India, which are cost centers, which are outsourcing centers for their parent. So their expenses are critical. Revenue is just an add-on of expenses. So they'll add 10% and recognize that as revenue. So their expenses are critical. There are companies which may be still in the setup phase, where there is a lot of fluctuation of profit. The revenues are not stable, or the companies have not started operations. In those cases, the net asset value may be relevant. So there are different parameters for setting up materiality, and these are some of the parameters that are used, and certain percentages are applied to them. Factors that may affect the identification of the benchmark. So this is what I just discussed, are the elements of the financial statements, which I just told you, briefly. Whether there are items on which attention of the users need to be focused, the nature of the entity, its life cycle. This is what I discussed, in the previous slide. The ownership structure, the way it is financed, the volatility of the benchmark. So these are some of the benchmarks, and these are some of the reasons why what benchmark should be used for determining materiality. For example, it says profit before tax from continuing operations is often used for profit-oriented entities. When profit before tax is volatile, other benchmarks such as gross profit or total revenue may be taken. Factors that affect the percentage to be applied include the following. Determining a percentage to be applied involves the exercise of professional judgment, which I said. So who judges what parameters is to be used? It is a professional judgment, and that is why I would say some experienced professionals need to be engaged to determine the planning materiality or the materiality. Because if the materiality parameters are not set right, the testing that will follow will not be appropriate. It will not be optimum testing. So that is why this is the beginning of an audit. So the first thing that an auditor would set is the planning materiality, and for that, senior engagement is required. And as we do this, a lot of hunch about clients, the client knowledge is required. The client operations knowledge is required. The volatility in the statements is required, is to be understood. So all those parameters are to be understood as we talk about planning materiality. Now, what are the percentages that are used? So I'll just come to that. There is a relationship between the percentage and the chosen benchmark, such as percentage applied to profit before tax will be higher than percent applied to total revenue. For example, for profit before tax, it could be 5 to 10%, which could be considered. For example, the revenue of a company may be, say, 10,000 crores, and the profit may be 500 crores. So we'll apply 1% of revenue. Again, there is a range which is there, and that range is determined based on the experience of the auditor, or it could be 5% of PBT. So this is how the benchmarks are applied. Now, these are some of the considerations while selecting the benchmarks. Profit before tax is nominal, and profit before tax and remunerations applied. Entities doing public utility, total cost or expenses less revenues is the benchmark. Current profits are low. Average of the past 3 years profits will be taken so as to even that out. Profit-oriented entity with break-even results, revenue will be taken as the benchmark. Private equity firm, primary focus on EBITDA. So if the user is the private equity firm, then EBITDA will be taken as the consideration. Production costs recharged to the group, production costs will be taken as benchmark. In case of mutual funds, net assets will be taken. So these are the various parameters which are considered. Again, having said all this, I would say the judgment of the auditor or the judgment of determination of the materiality is very important. Now, for materiality levels for particular class of transactions, account balances, or disclosures, some of the factors to consider in these cases are laws and regulations of the applicable financial reporting framework affecting the users. The key disclosures in relation to the industry in which the entity operates. So these are all for the particular level of transaction, for the particular account balances or for class of transactions. Now, whether the entity is focused on a particular aspect of the entity's business that is separately disclosed in the financial statement, for example, a newly acquired business. Revision as the audit progresses. So these are some of the, again, benchmarks or some of the factors that we will consider while determining the materiality. Now, the materiality, when is the materiality to be determined? For example, if for a listed company, the year end is March. However, the audit will be done, the reviews will be done in the months of June, September, December, and then the audit will be done in March. So for each of these reports that are issued by the auditor, or for each of the reviews or audits that are done by the auditor, materiality has to be determined. So materiality will be determined right in the beginning of the year. And this is based on the review of the draft financial results of the statements or the trial balance of the company. However, situations may arise. COVID happened, for example. When COVID happened, the entire landscape of the companies changed. The hospitality industry went through a huge, downside in their activity. So it doesn't mean that if the situations change, the materiality will not change. If the hotels, we were doing evaluating materiality on a profit before tax threshold prior to COVID coming in, we can't use the same threshold because the profit before tax went down significantly. So we have to revise. So there is a revision in materiality which takes place as the audit progresses. So I've taken a very radical case that COVID took place, but when should it get revised? So what is written here is the auditor shall revisit and if needed, revise materiality in the event of becoming aware of new information or a change in the auditor's understanding of the entity and its operations as a result of performing further audit procedures. So as we do our audit procedures and we get to know a change in circumstances of the company or the change in operations, the audit materiality will be revised accordingly. Now, you determine materiality. We know the reason for determining materiality. As I started this conversation, I touched upon a topic called documentation. When we determine materiality, it doesn't remain in our minds only. It has to be in our mind as we do the audit, what the materiality is, because if we come across a certain disagreement, that has to be evaluated in respect of the materiality that we have noted. However, having said that, this is at the back of the mind of every auditor who does the audit. Having said that, it has to be documented as to what is the amount of materiality, how did we determine the materiality, and what is the basis of arriving at the number of materiality. So these are some of the factors that are considered in the determination. This is what should be documented. Materiality of the financial statements as a whole, the materiality level for particular class of transactions, account balances or disclosures, performance materiality, and any revision of the above as the audit progresses. So these are some of the factors that are considered in determining materiality. This is what I have on the presentation, but now let me just give a few more words on this one as we progress. When we determine the materiality, there is another threshold that we determine, which is called the level at which adjustments will not be made. Different people have different nomenclatures for that, but that is what is I would say, the trivial threshold for materiality. Take example, as I took an example of a company which has got a revenue of 10,000 crores and say a profit of 800 crores. Assuming we do it on the basis of the revenue. The revenue is 10,000 crores, and if we take materiality as a 0.75%, it comes to 75 crores. So what it means is that all the differences that we note at the time of during the time of our audit, if they aggregate to 75 crores, and if they exceed 75 crores, then the results are materially misstated. If the total differences are less than 75 crores, then the results are not materially misstated in case we do not adjust them, in case the company does not adjust them. It also depends upon the nature of the misstatements, which I'll come to in my next slide. But what happens is that, supposing in case you have a certain lesser amount, and whether you need to make adjustments for a particular class of transactions which you refer to as the performance materiality, We also referred to it as the critical threshold. And that may be, which is a percentage of 75 crores, it may be, say, 5% of this, which comes to approximately 3.75 crores. So any amount in an account balance, which is less than 3.75 crores, is what we will not adjust in that account balance. In case it is more than that in that account balance, then we would be adjusting that amount. So I'm just giving you a very broad parameter for materiality as to how we will do the adjustments. So this is what it is. So very critical, determine materiality at the beginning. To sum it up, determine materiality at the beginning of the audit exercise. And you need to revise it based on certain testing that the auditors have done, and based on any changes that may have taken place during the course of the audit in the organizations. I would say in the entity's performance, in the entity's, natural progression as it happens. Account for those changes. There may be a merger, there may be a demerger, a new plant may have been set up, which may increase the profitability of the company or increase the revenue of the company. So based on those changes, revise the materiality as it goes along. The third thing is, having done that, keep that at the back of your head and make sure that whenever there is a discussion, any misstatement or any adjustment to be made in the financial statements, the materiality plays an important factor in that. So in performing the audit, keep the materiality in mind. And the next thing is that as you determine the materiality, document it for why that material amount has been arrived at, what is the basis of arrival of that, what is the threshold used, and the reason for arriving at those thresholds. So this is what you have to do as professionals for determining what the planning materiality is and for using the planning materiality in your day-to-day audit of the financial statements. So this is on planning materiality. I will hand it over. I am open for any questions on this before we move to the next topic. Anything, Sanjeev, from your side, or Vishal Bhai from your side, or Anil ji? I'm happy to take those questions, or from the public at large.
No, sir. As of now, no. Maybe towards the end, Anil Lal would be receiving questions, and he will take up those questions.
Okay. Happy to answer those. And my details are with Anil Lal. And at any point of time, in case you want to reach out to me, please feel free to reach out to me.
Yeah. No, sir. I mean, before your session ends.
No. Even.
I mean,
Sanjeev, even otherwise, किसी को कोई बात करनी हो कभी भी आ सकते हैं मेरे पास.
Thank you so much, sir. Thank you.
ज्ञान बांटने से ज्ञान बढ़ता है. क्यों?
बिल्कुल सर. Thank you.
हमको लेके चलना चाहिए अपने plan. और बाकी हमको सब कुछ आता भी नहीं है और हम भी सीख लेंगे इस बहाने और लोगों से. So with this, can I start the next topic now?
Yes, sir.
Okay, 1 minute. I will just need a while to share the screen again. For the next presentation. Just give me a minute.
Yeah.
Hmm. Yes. Thanks. So is the screen visible now?
Yes, sir.
Huh? Okay. Sorry, my mute पे चला गया, so I didn't realize how to unmute it. So
नहीं sir, आ रहा है
one of
visible.
my colleagues help me unmute it. So now I put it in slideshow also. So having determined materiality, we come to the next topic, which is evaluation of misstatements. Now, this has been effective for all the audits relating to accounting periods beginning on or after 1st April 2010, which is a long time back. So this has been in practice ever since, right since the beginning. And I also remember doing this during my articleship days in the early 80s. So this is a topic which has been there in different measure, but it has become of more relevance as businesses have increased. Now, what does this deal with? This deals with the auditor's responsibility to evaluate the effect of identified misstatements and on the audit and of uncorrected misstatements on the, if any, on the financial statements. So this deals with any misstatements that have been identified and their correction. SA 700 deals with the auditor's responsibility in forming an opinion, and to conclude whether reasonable assurance has been obtained that the financial statements are free from any material misstatement. So if you look at it, both the topics which have been selected today for discussion are, one is materiality and the other is misstatement. So this directly links with SA 700, which is the reporting of the auditor, and it talks responsibility in forming an opinion of materiality and misstatement. So both things are covered here. The objective of this standard is to evaluate the effect of identified misstatements and the effect of uncorrected misstatements, if any. So this links with the materiality standard that we have just discussed. When we talk about effect of uncorrected misstatements, we came to a point where we said that what is material to be corrected or not to be corrected. So the effect of uncorrected misstatements, if it is having a material impact on the results, and materiality comes from the planning materiality which has been determined. If you aggregate all the mistakes and put them together, and that goes higher than the planning, higher than the materiality, then the statement is not appropriately, I would say, presented. Then there is a misstatement. Then we cannot say that these statements do not have any material misstatement in them. Whereas if it is below that, and there are certain qualitative factors also which have to be considered. If it is below that, then one has to see whether it is a misstatement or not a misstatement. So this is what is relevant in terms of misstatement and materiality. So the objective is to, one, identify misstatements, to evaluate the effect of misstatements and the effect of uncorrected misstatements. So this is the objective of this exercise. What is a misstatement? We've talked about misstatement all the while. What is a misstatement? This is the difference between the amounts, classification, presentation, or disclosure requirements. Anything could be a misstatement. Even a disclosure could be a misstatement. For example, if there is a related party disclosure that is being made, your profit and loss is fine, your balance sheet is fine, but your related party has not been correctly reported, your segment has not been correctly reported. So that could also be a misstatement. So it is any misstatement which is not in accordance with the applicable financial reporting framework. Now, these can be errors or these can be frauds. If the company, and that is again a judgment which we have to take, is it an error or a fraud? So it could be arising from both the matters. So that is a misstatement. What is an uncorrected misstatement? This is the total amounts that have been accumulated during the course of the audit and that have not been corrected. That is an uncorrected misstatement. I'll just give a very small example. This is something which touches the heart of an auditor every day. And a lot of us who are sitting with us today would have been auditors in life. So we come across a particular misstatement. For example, the company wants to account for a particular matter in a particular manner. They say that, a provision does not have to be made for an audit, for a debtor, for trade receivables. They say that the trade receivable is collectible. This is an error of judgment, I would say. Whereas the auditor is of view, this amount has been collected for 5 years. I've been getting explanations from year on year, and still the amount is not coming. There have been 3 months have elapsed since the end of the financial year. There is no confirmation from the company, or the company is disputing, or the auditor has knowledge which is in the public domain that the company has gone bust. So this is, in such a situation, the company says, okay, provide for this amount, and the company does not provide for an amount. So this would result in a misstatement. So this is an identification of a misstatement. And such misstatements, if they're aggregated and have not been corrected, these become uncorrected misstatements. So this is misstatement and uncorrected misstatement. All these identified misstatements are accumulated. Other than those that are clearly trivial, I touched upon this triviality in the earlier accounting, earlier standard on auditing that I discussed. There could be very minor which are misstated. So other than those, which these trivial ones are not even worth thinking about, they are left. For example, if there's a classification from traveling, it has gone to conveyance or conveyance to traveling. These are trivial ones which do not impact the financials. Pick up the significant ones and put them together. So these misstatements, these are the auditor shall determine whether the overall audit strategy and audit plan needs to be revised if we come to a lot of material misstatements, or we come to a lot of identified misstatements. So if we do the audit as auditors, and we keep on coming across these misstatements, then we need to see whether we need to revise our audit strategy. Because as we see that, because that at some point of time controls are not working. So revising an audit strategy would mean that we have to do more in-depth checking, or we may have to look at certain account balances in great detail. The aggregate of misstatements accumulated during the audit approaches materiality. Supposing it is about to cross the threshold of materiality, then the audit strategy will need to be revised. So these are the factors in which the audit materiality may need to be, the audit strategy may need to be revised. Now, we come across these misstatements. So what do we do with them as auditors? These should be communicated with the management at all points of time. All misstatements should be communicated unless it is prohibited by law or by regulation. Now, if there is a certain law which is at play, which, because of which we do not need to communicate with the management, that is a separate issue. I don't have an instance right now in my mind, but as it comes to my mind, I'll let you know where are we prohibited by law. And once we identify these misstatements, we should request the management to correct those misstatements, so as to keep on correcting misstatements as we come along. Now, it is easier said than done that we are coming across a lot of misstatements. If we come across lots of misstatements, then we need to evaluate also. Now, I'm stepping away from this standard here slightly. The auditor needs to evaluate as to what are the reasons for the misstatement, and is it that the company has a weak control, or is it that the company wants to show different results, which could be, a fraud by the company. So then one has to see what is the reason for those misstatements. At times, the reason is very trivial, or very, I would say, inappropriate. The management has given a certain number to the stakeholders, to the board of directors, of revenue and of profitability, and they want to stick to that number. So because of that, they do not want to make any changes, and they resist any changes to the misstatements. So there could be multiple factors. So anyways, having come across the misstatements, it is our responsibility to go to the management and to request them to correct those misstatements. In case the management does not want to correct those misstatements, then we need to understand from the management as to why they don't want to correct those misstatements. Based on the understanding, then we have to see whether the financial statements are representing a true and fair view, and they are not materially misstated. So there could be multiple reasons why management doesn't want to correct the misstatement. There could be a difference of view they may be having additional knowledge which they may share with us later as to why, they want to correct the mistake. Or they are interpreting the accounting standard in a certain manner, and we as auditors are interpreting in another certain manner. So there could be various reasons, but we should understand it and then see if we agree with the management that their reason is correct for not correcting it. We need to document as to what was our view, what is their view, what is the management's view, and then reason out and then document the reason for not making a correction. But in case we are still of the view and we are backed by our facts that there is a misstatement needs to be corrected, then we need to get it corrected or appropriately put a note in the auditor's report. Prior to evaluating the effect, we should reassess the materiality. Now, again, what makes it material is the materiality that we have determined at the beginning of the audit exercise. Now, the auditor should also determine whether uncorrected misstatements are material individually or in aggregate. So we talked about planning materiality and we talked about overall materiality. So we have to keep both those parameters in mind. The auditor should understand the size and nature of the misstatement in relation to a particular set of transactions and also in relation to the financial statements as a whole. The effect of uncorrected misstatements related to prior period on the relevant class of transactions, account balances. Related to the prior period, related to transactions, account balance or disclosure, and the financial statements as a whole. So we have to look at the misstatement and the effect of those misstatements. Now, having said that, we also have to communicate with those charged with governance. Now, those charged with governance could be the board of directors, the audit committee, or the senior management. In most cases, those charged with governance are the audit committee and the board of directors. So we should communicate with them on the uncorrected misstatements and the effect that the uncorrected misstatements have on the financial statements. The auditor's communication shall identify the material uncorrected misstatements individually, and we should request that uncorrected misstatements are corrected. Now, this is with the board or the audit committee. We should also, as auditors, communicate with those charged with governance the effect of the uncorrected misstatements related to prior periods on the relevant class of transactions and the financial statements as a whole. So once we have come to the misstatements, then we have to communicate with them as to what all does it impact, whether it impacts a prior period, a certain class of transactions, and the financial statements as a whole. I'll just give a small example here. There may be a misstatement. Say, for example, in receivables or in, say, assets. There could be current assets and non-current assets, and the company may have a view that it is a current asset, whereas the auditor may have a view it's a particular item is a non-current asset. And if it has been put in that certain category, if it is put in the wrong category, it may not have an overall impact on the profitability of the company, but only on the disclosure between the current and the non-current assets. So we have to come across and tell the client, tell the board and the management as to what will be the impact of the material, or what will be the impact of that misstatement. Now, having looked at the misstatements, we shall request a written representation from the management or from those charged with governance, which is the audit committee of the board, whether they believe that the effect of this misstatement are materially, individually, and to the financial statements. And a summary of such items shall be included or attached to the written representation. So we should take a representation from them that these are the misstatements, and these have been identified, and in the opinion of the management, whether they have an impact on the financial statements or not. The management may say that this does not impact the financial statements, and if it is below the planning materiality, yes, it may not, and it may not need a correction. But the management should represent that they acknowledge that there is a misstatement not being adjusted because it is not material. If it is material and if it is still not being adjusted, Still, they need to give a representation that yes, this is material, it is being not affected, and then the auditors will stand to qualify the report. What is the audit documentation that is required? We've done all the work, we found misstatements, we have gone to the management, some things have been corrected, some things have not been corrected. What is it? We still need to document that on our files as auditors, and what is the documentation that we need? Now, this documentation should include the amount below which misstatement should be regarded as clearly trivial. So we need to put that this is the threshold which are clearly trivial, I would say, misstatements, and they need not be adjusted. All misstatements accumulated and whether they have been corrected. So if there are misstatements, we should put on the file, yes, there are misstatements and they have been corrected. In fact, they should be brought to the attention of the audit committee or those charged with governance that these are the misstatements that we have corrected during the course of the audit. And if these misstatements are material, and if they are systemic in nature, that they could at a later point of time result in a misstatement of the financial statements in case these are not corrected or if the systems are not in place, then this may need a qualification in the internal controls report over financial reporting, ICOFAR report. So though all those things have to be evaluated, then we have to also document the auditor's conclusion as to whether the uncorrected misstatements are material individually or in aggregate, and the basis for that conclusion. It is not that it is my word against yours. We have to put all the misstatements, give a reason whether they are material, not material, and what will be the impact on the financial statements or on the auditor's report. Accumulation of identified misstatements. Matters that are clearly trivial will be of a very small magnitude than materiality determined in accordance with SA 320, which we just discussed. When there is uncertainty about matters are trivial, matters should not be considered to be trivial. Supposing there is a judgment and a particular auditor is of the view that it is trivial, whereas somebody is of the view in the same auditing that it is not trivial, then we should not consider it as trivial, and that should be included in the list of misstatements. Evaluation of the effect of misstatements accumulated during the audit and in communicating to those charged with governance. Distinguish between factual misstatements of misstatements, as I rightly said that there are judgmental misstatements a short while back. There has to be a distinguishment between factual misstatements, judgmental misstatements, and projected misstatements. Factual misstatements are judgmental misstatements I just talked about, where the auditor is of a certain opinion and the management is of a certain opinion. And the opinions don't match, but based on auditor's judgment, the management judgment, a certain misstatement has been determined whether adjusted or not. Factual misstatements are there is a clear error. There is no doubt of that. Maybe sales have been overstated. It has been proved by way of the invoices that have by means of the dispatches which have been made, and certain things may have been recorded where they should not have been recorded. So those are factual mistakes. And there are projected misstatements. Projected misstatements are the ones where certain projections have been made which are incorrect. So those are projected misstatements. Consideration of identified misstatements as the audit progresses. A misstatement may not be an isolated occurrence. For example, where the auditor identifies a misstatement from internal control which is not working. So this would be something which would be recurring in nature. So there are certain considerations when we identify a mistake, when you identify a misstatement. So in case there is a breach in control and a misstatement has been identified with that control breach, then the auditor needs to change his audit strategy and ensure that there are no more misstatements on account of the broken control. Further, if the aggregate of misstatements accumulated approaches materiality, then there may be a lower level of risk that that the possible undetected misstatements when taken with the aggregate of misstatements could exceed the materiality. So there is this possibility that where the aggregate happens, then it may exceed materiality. In such cases, what does the auditor do? He requests management to examine that class of transactions, account balances, which could get affected by these misstatements, and perform procedures to determine the amount of actual misstatement and to make appropriate adjustments. So at that point of time, the auditor should step in, tell management that these are where we expect the errors to take place because the controls have broken down. Please do an evaluation, come to a decision, and then make appropriate adjustments. Timely communication of misstatements is important because it enables management to evaluate what are the misstatements, the reasons for these misstatements, and take corrective action. Lots of times, clients come back and tell auditors that you told us everything at the end. Now, one has to always keep on communicating the misstatements and getting them corrected. Now, in certain cases, law may restrict somebody to inform the misstatement to the client, particularly, which is what we talked earlier, and I said I'll come back to you with examples, and here is where we have an example, may specifically prohibit a communication that might prejudice an investigation, and investigation may be going on, and the statutory audit is also in progress. So the management may be prohibited from, the auditor may be prohibited from informing the management about any misstatement, because the legal framework wants the misstatement to be informed to the authorities first. So in such cases, in case an auditor is prohibited from from discussing any management, and there is a discussion and the management is pressing for that, the auditor should seek legal advice as to whether he should inform the management of those types of governance or hold it back. So these are the only situations where an auditor may have to hold back discussion of any misstatements with management. What does this correction of misstatements mean? It is just meaning that the correction of misstatements which have been informed to management or those charged with governance is only enabling the management to accurately maintain its books of account, correct its books of account, and ensure that the financial statements are fairly presented. So, coming to evaluation of misstatements, if you look at it, we have to revise the materiality. In case the misstatements happen to be significant, then we may have to even revise the materiality based on the actual financial results. Materiality is revised if the auditor is aware that there is some issue in the audit that would have resulted in the auditor having a different amount of materiality. The appropriateness, nature, timing, and extent of the audit procedures. Each individual misstatement is considered to evaluate its effect on the relevant class of transactions upon balances. And if an individual misstatement is judged to be material, it is unlikely that it can offset other misstatements. So it is not that an individual misstatement can be offset by other misstatements. Each misstatement is separately. It is only possible to offset in case it is in the same account balance or same class of transactions. Otherwise, the misstatements cannot be offset by each other. Circumstances that may affect the evaluation include, what are the circumstances that may affect the evaluation? This is, which including the extent to which the misstatement is there, is it affects the compliance with regulatory requirements, affects compliance with debt covenants. So these are all the circumstances which could impact the financials. Relates to the incorrect selection of application of accounting policy that has a material effect on current period financial statements, makes a change in earnings or other trends, affects ratios, affects segment information, it is not only the profit and loss account but the balance sheet. These are the various impacts that could affect, the financial, the misstatements could have various impact on. It could have an impact on increasing management compensation. It relates to items involving particular parties. So these are the various impacts that a misstatement could have. The cumulative effect of immaterial uncorrected misstatements related to prior periods may have a material impact on the current period financial statements. There are different acceptable approaches to auditors' evaluation of such uncorrected misstatements. Using the same evaluation approach provides consistency from period to period. In case of audit of certain entities such as governments, the evaluation is affected by legislation, regulation, or other reporting responsibilities. So in case of a government audit, the evaluation of misstatements will be totally different. Now, again, coming back to communication with those charged with governance, if uncorrected misstatements have been communicated with those charged with governance or with management and those who have governance responsibility, they need not be communicated again with the same persons in their governance role. Where there is a large number of individual immaterial corrected misstatements, the auditor may communicate the entire amount rather than individual amounts. The auditor can also discuss the reasons and the implications of the misstatements with the management and with those charged with governance. Written representation, I've already come to that earlier. It is very important to take a written representation of the management of the misstatements that are there. And having taken the representations, those representations should be kept on record. In case the management believes that the amount is not a misstatement, but the auditors believe that there is a misstatement, again a representation should be obtained. That the management may want to add that they do not agree with the auditor for those misstatements. However, even having taken this representation, it doesn't mean that the auditor can give a clean opinion in case he thinks that the misstatement is material. So it does not form a basis for his conclusion of the financial statement report. Documentation, I've discussed that earlier also, just repeating it here, that all material misstatements or immaterial misstatements have to be documented, material misstatements have to be corrected, non-material misstatements have to be aggregated, and they have to be communicated with those charged with governance, and together with the impact that it has. Now, in the international standards on auditing, there was a paragraph 19 which stated that in case of an audit of public sector enterprises, the evaluation may be affected by legislation or regulation. Now, this paragraph has been taken out. This has been deleted because the international standards on auditing believes that the standards on auditing, whether for government agencies or for the private agencies, remain the same. So there is a slight difference between that and the Indian standards on auditing in India. This is all from my side. I know this has been a slightly longer conversation as compared to the earlier one. I was allotted 2 hours, but I was sure that I don't need more than an hour to do my discussion, and I'll open it to the audience for any questions that they may have. I will answer these to the best of my ability. These are my personal views that I will provide on this forum. I'm happy to take any further discussion if required. Over to you, Sanjeev ji, Vishal ji, Anil ji, and to the audience. Anil ji, any thoughts? I think Sanjeev is not here. Neither is Shalji here. Any thoughts, any views from the audience? Happy to take those views, audience views also.
Sir, can you hear me?
I can hear you now.
Sir, you are through with both the presentations?
Yes, I'm through with both the presentations. I've opened it for questions from the participants.
Sir, due to some technical glitch, we are unable to fetch the questions right now. In the starting, I have received one question. I am sharing with you, sir. But
Okay.
my technical team is trying to fetch the question, more questions, sir. So, question is no cumulative figures of bad debts written off so far appear in the financial statement.
Sorry, I couldn't understand the question. No.
No cumulative figures of bad debts written off so far appearing in the financial statement of the company.
Okay.
While company is trying to collect or recover the amount from the parties simultaneously by adopting legal procedure. So, reader of the financial statements do not come to know how much amount is to bad debt to be so far has been written off or how much is company is going to write off. So, what your opinion is there, sir? What you are giving your expert advice on this, sir? In case of the written off of the bad debts.
So, I can't give any advice on this right now. It depends on situation to situation and what evidence is available with the company that they can satisfy the auditor report.
Yes, sir.
So this is not a topic related to this particular, I would say, standard that we have discussed. But okay, having said that, if it is material, then the auditor has to take a judgment on whether with the appropriate documentation it is recoverable or not. It is a judgment issue in case based on facts and circumstances of the case and based on the evidence available with the client, whether it is recoverable or not. The auditor is of the view that he cannot form an opinion that it is recoverable. He needs to, and the company is not writing it off, then he needs to highlight that in his auditor's report.
Yes. So one question is, how can you say that, or how can you put light that is materiality is relating to the sampling? How sampling is also affect sampling and materiality?
Yes, it is affected based on the materiality. The sampling is, the samples are drawn. So depending on the materiality and the probability of error that may take place, which are all judgments, and there are certain formulas to it also, which are used, then the samples are drawn. For example, take a take two diverse cases. There is a situation in, say, an oil producing company where the oil is produced and they are selling the oil to a particular company, which is maybe a PSU, say Indian Oil for refining. And as they sell the oil, they make the invoice on a monthly basis. So there are 12 invoices raised in a year. Now, the sampling procedure there will be very different as compared to a hotel where they are having, say, a 200-room hotel. All 200 rooms are booked. And they are having, say, maybe 20,000 invoices in a year. So there the sampling will be extremely different. So it depends on the volume of transactions and the level of materiality which is determined, which helps us in selecting the invoices. So that is where, there are multiple factors. It is not, sampling is not only dependent upon materiality, but yes, materiality is one of the factors which is considered into deriving the sample.
Yes. So one member is asking, as we all are aware that in many of the cases, actions got established in later years for the board of directors or employees of the company in awarding of the job or tender processes which related to a particular financial year in the past? And will such proven of wrongdoing of on part of the board of directors or wrongdoing of on part of the employees of the company in tendering be attracted towards the audit materiality?
Sorry, what will happen in case of such wrongdoing?
In past, some wrong
Right.
tenders have been awarded or wrong job have been awarded by the board of directors or by the employees of the institute or by
Right.
the employees of the company or by the employees of the organization. Then will such proven of the wrongdoing by board of directors, the company in tendering in attending the audit materiality?
No. Again, the question is not very clear to me, but let me just answer whatever I've understood here. So there has been some wrongdoing in the past.
Yes.
Now that wrongdoing
in the company
past,
wrong has been done in the past.
Yes, there has been some wrongdoing in the past in tendering. Now it depends on what is the loss that the company has suffered because of that wrongdoing. So if that loss which the company has suffered because of that wrongdoing, if that is more than materiality, then yes, there should have been an adjustment to the financial statements. Whereas if it is trivial or if it is less than materiality, then there is no adjustment to be made. But again, in such cases, if there is a fraud, then that fraud is to be reported to the MCA by a different mechanism altogether. So in which case, if there is a fraud and that is reported separately, then that is different. And in which case, a report will need to be issued even if the amount is not material. So materiality also, misstatement also, it need not be within the threshold of materiality in certain extraneous circumstances, like where there has been a fraud. So it doesn't mean that that will not be reported. These frauds will be reported, but these are not misstatements. These, as I said, misstatements are due to errors and frauds. So if there is a fraud, even there will be a lower threshold of materiality in that case.
So what about the time gap of establishing error in the past, or sorry, in the present time of the past financial statements?
Can you please elaborate on that? What do you want to hear from me?
So in the same relating to the above question, where the wrong thing happened in the company by the board of directors. Now, what about the time gap of the establishing error, such type of error in the present time of the past financial statement, relating to the past financial statements?
So what is the question? Supposing an error has been established in of the prior financial statements, again, as I said, the amount of misstatement will have to be recognized, and that will have to be, if it is only a prior period statement. No, there are different treatments in Ind AS and there are different treatments in Indian GAAP. If it is Ind AS, then the prior period financials will have to be revised for 1 year, and the prior period to that, the revision will be done to the reserves. Whereas if it is Ind AS, if it is Indian GAAP, the erstwhile GAAP, the Indian GAAP, not the Ind AS, then the entire impact will be taken in the current year's financial statements. So what I mean to say here is, if there is a restatement of if there is an error of the past which has been surfaced, and that will either be corrected in the current year in the current year's financial statements in case of old GAAP, and in case of Ind AS, it will be corrected in the last year financial statements, and it will be written in those financial statements that these have been restated. Notes will have to be given why these have been restated.
Yes, sir. So apart from the board of directors, who are the other interest groups who represent those charged with the governance in the auditing company?
It is the board of directors or the audit company. These are the primary people who are charged with the governance of the company's matters.
Yes, sir. So thank you so much, sir. These were the questions we were able to fetch right now. Whatever the other questions I will receive from the members, I will forward the same to through mail to you for the answers, sir. And then accordingly,
happy to take any questions.
Yes, sir. Yes, sir. Yes, sir. So thank you so much, sir, on behalf of AASB of ICI for sparing your valuable time and acceding to our request, sir.
Thank you.
So much.
I'm giving more than half an hour back to all the participants.
Yes. Thank you. Thank you, sir. Thank you, sir. Thank you.
Thank you so much.
Namaste.
Bye.
Thank you.